We have been on a amazing run of different growth stocks that are currently decent deals in the market today. So I figured, why stop now? Let's hit it with another one. So today's stock is Coherent, ticker symbol COHR, and this is an electrical component company with a current market cap of about $4.3 billion. Now, really quickly, I think it's important to cover what does Coherent do as a company, because saying it's a electrical component company is not very specific. So basically, this company makes laser equipment and other support equipment and technology that goes along with the lasers, and these lasers basically help in very precise manufacturing and relay and communication of data that you would see in a data center. So on the left hand side, Coherent is basically comparing and contrasting electrons, kind of the old method of how energy is transferred, to photons, which uses light instead of electricity. So as we can see, they show that the speed is at light speed. That's, as fast as things get, that we currently know at least. And there's very, very little, if any, energy lost. So that makes it very, very efficient and also less prone to overheating. What is also interesting is that the light technology that Coherent uses in its lasers has 10,000 times more information capacity when compared to an electron. So this is clearly a huge step forward in what's possible for technology and for transmission of data and for precise manufacturing. And so in this slide here, we can basically see the two most important segments that Coherent focuses on, and that is data centers and communications, and then industrial engineering. Again, that precise engineering. They show cars here, but they also use these lasers in electronic manufacturing, so like microscopic level manufacturing, and everything in between. I thought it would be really important just to take a quick second to talk about the supply chain resilience that Coherent is built, because that is important in this day and age with tariffs as well as just general geopolitical instability. And so we can see that they've had huge capacity increases in their different segments. And there's also many different countries that Coherent does its manufacturing and assembly and testing in. So this company is very well positioned to handle geopolitical risks, which is not something you can say for a lot of different mission critical manufacturers, like let's say Taiwan Semiconductor, or really any of those semiconductor fab companies at this point in time. And so one last thing I wanted to touch on before moving into some of the results from their most recent earnings. This is what the company is expecting to see growth over the next 3 to 4 years. So in their data center and communication segment, they expect 15 to 20% plus compound annual growth rate. And in their industrial sector, they see 5 to 10% compound annual growth rate. And that's going to combine to a target growth of about 10 to 15% for the next 3 to 4 years, which I imagine, as long as there is no major disruption in global supply chains, I imagine that is a quite achievable rate of growth. And I did totally lie. I do also want to quick point out that this company is focusing on expanding its margins, aiming for 42% gross margin and a 24% operating margin. They do not give a specific target, but they do state that they want to reach that target in the next 3 to 4 years, hopefully. Whether they will be able to reach it or not is up for debate, but 13% to greater than 24% operating margins would be huge for this company and lead to a massive increase in profitability. So there's definitely a lot to love from Coherent on the growth front. So now I've switched over to their most recent earnings presentation. This came out earlier this month in August of 2025. And as we can see, the company saw huge revenue growth at 23%. They also saw gross margin expansion of 358 basis points, which is 3.58%. And a 191% increase in their earnings per share between fiscal year 2024 and 2025. So absolutely massive growth for this company. We can see that data centers and communications make up the majority of the company's revenues at 59%, and then industrials make up 30%, with electronics and instrumentation making up the remaining about 12%. And what I think is important to note is that there's huge growth in data center and communication revenue, 51%. That's really driven by these large data center buildouts that we see coming online. The Metas, the Googles, the Amazons, the Microsofts, all these companies trying to build these massive data centers. They're going to need equipment and supplies for those data centers, and that benefits Coherent. But under the hood, we do see a contraction in revenues in their industrial segment. And I think this also makes sense because we have seen a much weaker industrial situation in the United States and the developed world, as the more physical economy outside of technology does seem to be slowing down a little bit. And so I don't think this is necessarily Coherent's fault. I think it's a sign of a greater issue, but it is something we need to keep an eye on, considering it is about 30% of the company's revenues, as I just mentioned. And so what was really interesting is the earnings I just showed you when they were released in August led to a nearly 20% drop in the stock price, which is very, very interesting. And the Motley Fool puts it bluntly, a double beat just wasn't good enough for this company. And what seems to have worried Wall Street and analysts is the fact that Coherent's revenue growth in the data center space continues to slow. And they saw a 24% growth in Q4, but that's compared to 39%, 46%, and 58% in the preceding 3 quarters. So 24% growth is absolutely huge, but obviously when you compare that to 40% and 50, maybe 60%, it does look like quite a slowdown. And so that's the risk that you run being a growth investor, is that eventually that growth train does stop or it hits a speed bump. And if you're paying very high valuations for these companies that are growing really, really fast, the second they stop growing really, really fast, or even just slower than they were in this case, you're going to see some major drops in share prices. So knowing that this company just saw a large drop in its share price, I think it's important to ask, was that drop justified? Is the company still overvalued, or are we looking at the possibility of a really solid long-term investment? So let's get into the numbers, but before we do that, please remember, like the video and subscribe to my channel. I hope to bring a ton more videos like this to you, and if you have a stock that you'd like reviewed, feel free to leave a comment, and at the very least, I will leave a comment leaving my thoughts in response to your comment, but I might even make a video on it. So with that, let's get into the numbers. The company's revenue growth since 2020 has been really strong at about 17%, with EBITDA growing at 13% and free cash flow growing at 10% per year over the last 5 years. Now, what's important to note is the free cash flow especially seems to be much more variable, hitting a peak in 2020 of 361 million, then going negative in 2022, and now landing somewhere around 530 million. So excellent growth, but certainly not consistent. Margins are much the same story, with gross margins being 35% and staying relatively stable, although they have contracted in the last few years, and operating and free cash flow margins sitting between 9 and 10%, which is not bad. But as we can see, both the operating margins in this medium blue and the free cash flow margins in this dark blue do see quite a bit of variation between quarters and years. And so that is something to watch to see if Coherent is able to stabilize those margins and then get into a regular expansion of those margins. The company's quick ratio is 1.39 and its current ratio is 2.19, suggesting their balance sheet is in excellent health. And as we can see just from the graph, the total assets in this light blue vastly outweigh the total liabilities in the dark blue. So I really see no issue with Coherent's balance sheet. The company does carry some debt, but that debt is well covered by its EBITDA at 4.5 times and its free cash flow at 2.2 times. So I have no worries that Coherent may not be able to meet its debt obligations. Now, what does give me a little bit of pause as a shareholder is the fact that the shares outstanding have been growing at nearly 8% per year for the last 5 years. And we can see that a major jump in shares outstanding for Coherent occurred between 2021 to 2022 and into 2023. And since 2023, that growth in shares outstanding has slowed. So hopefully the company is done issuing shares to the market and can potentially start buying back shares in the future. But that is something you certainly need to be aware of, that your ownership, at least if the past is any indication, will be diluted by the company's management. Coherent does not pay a dividend, so we're just going to move on from that. And we're going to focus on price to sales, where the company is currently trading at about 2.39 times its sales versus its long-term average of 1.72, suggesting this company is about 40% overvalued today, even after that 20% drop in share price. Now, with inconsistent earnings, the price to earnings chart is not very helpful, but if we move to a price to EBITDA chart, we see a much more stabilized picture, and the company is currently trading at 12.6 times its price to EBITDA versus its long-term average of 9.4, again suggesting that the company is currently overvalued, this time by about 34%. Coherent is also overvalued on a price to free cash flow basis, trading at 26 times versus its long-term average of about 15.5, which suggests a premium of 66%. The price to book ratio confirms much the same thing, that the company is likely overvalued, with a current premium of 38% over its long-term average. And even switching over to enterprise value versus EBITDA, we see that Coherent is just plainly overvalued compared to the last 5 years, currently sitting at a premium of 45% on an EBITDA basis and nearly 94% on a free cash flow basis. Taking a quick look at the company's drawdown chart, we can see that Coherent is no stranger to large drawdowns, and curiously, the drawdowns seem to be getting more and more extreme as time goes on. The company currently sits in a 22% drawdown, which is indicated by this blue line here, and that would be largely a result of the earnings disappointment from Wall Street. But not even a few months ago, the company was sitting in a drawdown of 54%, and less than a year or two ago, the company was sitting in drawdowns as low as 70%. So Coherent is not a low beta stock by any means. This company is a roller coaster. And so if you are going to buy this company, be prepared to hold it through very large drawdowns. And so moving on to analyst estimates for earnings per share. On the right-hand side here, we can see the next few fiscal years earnings per share estimates. But what I like to take a look at is this chart, which visualizes not only the earnings per share over time, but the change in analyst expectations for those earnings per share. So in the light blue, we have estimates from 6 months ago. In the medium blue, estimates from 3 months ago. And the dark blue representing the most recent estimates from analysts. So what we want to see is an upward sloping line, meaning analysts estimate the company is going to earn more money in the next year than it did in the previous year. So that checks the box there. And the second thing we want to look for is that analysts are being more bullish on the company over time. And again, Coherent checks that box with the 6 month ago earnings estimates being below the 3 month estimates, being below the current estimates. What does that translate to? It translates to analysts believing that Coherent will earn more money, not only forward in time, but seeing growth in that expectation for earnings in a static comparison to itself. So what does that mean on a forward PE basis? Well, ignoring the fact that the average PE is listed as negative 3.5 due to some major skew from the data in like 2021 or 2022, we can see that the forward PE is currently implied at 25 times, but as soon as we get to 2027, the forward PE drops as low as 15.5 times, meaning if Coherent is able to deliver on its growth promises, buying today may not be a very bad long-term price because you're getting it at a fairly good deal, 15 times its 2027 earnings, suggesting that its 2028 and 2029 forward price to earnings ratios would be even lower as well. And so, as always, I like to take one final look at what I call the 3 X factors of a company. And that first X factor is 5-year expected earnings per share growth. And Coherent is absolutely crushing it, with analysts expecting nearly 29% compound annual growth for the next 5 years. That's excellent. Very few companies on this planet are able to replicate that. And so that's a huge green flag for Coherent. Its PEGI ratio is negative due to the fact that its price to earnings on a diluted basis is currently negative as well. So that skews the data. We have to ignore it. And when we look at the company on the FG ratio, which is the comparison of its enterprise value divided by its free cash flow, so another form of profitability, and then compares that to its long-term growth plus yield, or the total return of the stock, we get 1.13, which is very, very good. And we did see that Coherent was very highly priced when compared to itself over a 5-year average, but that seems to be justified by the expected growth that analysts believe will come in the future for the company. Now remember, any number that is less than 1 is excellent. A number between 1 and 2 is pretty solid, and obviously the lower you can get, the better. And then anything over 2, generally you can ignore unless you're in a very slow growing industry. So 1.13, certainly excellent. It does mean that although Coherent does seem highly valued, that high valuation might be entirely justified. And so for my final recap of Coherent, I'm going to give this a safety score of 3 out of 4. And now the reason I don't give it a perfect 4 out of 4 is because the company stock is highly volatile. So that does make it a rather risky bet just due to volatility and not knowing if you're able to diamond hand it as well as other people might be. But moreover, this is a technology stock, and technology, whether we like to admit it or not, is disrupted very, very often. So there's amazing growth ahead for Coherent. How long does that growth last before some other crazy new technology comes around to replace it? I don't know. So I think 3 as a safety score is really fair. The company has a great balance sheet. and it seems to have a really clear growth runway ahead. For quality, I gave it a perfect 4 out of 4 because Coherent, again, has really great growth runway. Its products are very integral to a lot of the major growth industries of today. The balance sheet is very, very strong, so there's basically no insolvency risk as it stands today. And the company is investing heavily in improving its margins, improving its products, and continuing to stay on the cutting edge of technology. So I think this is a very, very high quality company. It's hard to argue anything other than that. But for value, I had to give it a 2 out of 4. Why? Because I spent a very large chunk of this video basically saying that the company is 30, 40, 50, sometimes up to like 80 or 90% overvalued based on its 5-year averages. And I can't ignore that, even if our growth ratios might show that the higher valuation is justified by the potential growth. Because as analysts and Wall Street now worry, maybe that growth engine isn't as strong as they once thought. And so that could lead to a continued significant contraction in valuation for Coherent. Now, in a perfect world, if Coherent hits all of its goals, I think this value score definitely jumps up to at least a 3, maybe even a 4. So you're going to have to decide for yourself whether you think the company's goals and the overall total addressable market growth will lead to a major boom. And then finally, the X factors, I give it a 2 out of 3, largely because I just have to ignore the PEGI ratio. With that being negative, I really can't give it a good score for that. But the other two X factors, that is 5-year average earnings growth expectations, and the FG ratio, which compares free cash flow to total return. In both of those ratios, the company looked excellent, suggesting that even though Coherent is rather expensive, there is at least a decent bit of safety in the fact that the company is expected to grow so much that its current valuation is justified, if not perhaps a little bit undervalued. And so that leads to a final score of 11 out of 15, which I think is fair. I could kind of also see an argument for like a 12 out of 15. I think Coherent is an excellent company. My biggest issue with it currently is just that it has a somewhat high valuation based on its long-term averages. So if we were to ever see Coherent take a significant drawdown, as it has been shown to do in the past, I think this would be an excellent company to do further research in and keep on a short list of potential investment candidates. Of course, this is not financial advice, so please do your own research before buying Coherent. Don't just go out there and buy it because I say it's a decent stock. And with that, I hope you guys enjoyed the video. Please remember, like and subscribe to the channel, as there are plenty more videos like this coming. And if you have a few extra moments, leave your thoughts down in the comment section below. I would love to hear what you think about Coherent. It's a very interesting company to me, and I see some growing hype around the company. So I would love to know what you think of it, if you find value, and if you do, what are your price targets? Where do you think the company's going? Why do you think it's going there? Stuff like that. That would be really nice to chat with you guys about that. So with all that, I hope you have a wonderful day, and I will see you all in the next video. Bye.